The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
Hello, everybody. Welcome to another episode of Fix It Friday. Today, I'm going to talk about two things that are related, which is the financial media and big Wall Street firms, how both of those entities, which many investors view as entities that are out there to help them make better decisions about their planning, about their investments, rely on almost daily by tuning in to CNBC to kind of figure out what's going on in the financial world and what maybe the investor should do about it. So the trouble is that when we dig deep into those relationships, the one between big media and big Wall Street, they're very problematic. So the goal of the investor is to say, let me tune in and see how I can get some help. The goal of big media is not to help the investor. In fact, I would say, from being in the business 35 years, most of these media people are not able to help the investor. They're not qualified to help the investor. So what they're really doing is they're looking to increase ad revenues for the media company. And the way they do that is they make stories that are as sensational as possible come out as often as possible on almost a 24/7 news cycle. And in the general media industry, there's an old saying that says, if it bleeds, it leads. So we're going to report on the shark attack and the plane crash, things that don't happen often, but things that people are going to be very frightened about. And the more clicks that will result from that reporting on our stories, the higher our ad revenues. So that's the goal.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
Financial journalism is not really journalism. It's really results-oriented marketing disguised as journalism. And the results they're looking for is higher clicks and higher ad revenues. Now, the trouble is they're in a collusion with big Wall Street. So when you see all of the big Wall Street firms, managing directors, for example, at big titles, they'll appear regularly on CNBC. And sometimes often you'll have two of them on the left, one on the left side of the screen, one on the right. And they'll come at them with this unanswerable question. For example, a little less than 2 months ago, beginning of April, we had 2 days of back-to-back 5% decline, which was historic. And so during that 10% decline in 2 days, the question was posed, is this 10% decline the start of the next bear market, or is it a buying opportunity? I don't know. Flip a coin. But the reason they asked that question is big Wall Street firms have an incentive to get the investor concerned. Because if you're not concerned and you just stay still with your portfolio, you're not buying their expensive products designed to, quote unquote, protect you against the risk of the markets, which is broadly defined in our industry as up and down movements, temporary, of the price of the investments that we own. And so by getting it to react, they increase their sales, they increase their profitability. So they're actually doing the opposite of what my firm does, which is teaches investors never to react to current events, politics, or market moves in a way that they would change their portfolio in response to those things. Only change the portfolio or the plan in response to your objectives changing. The media and the big firms do the opposite because, again, their goal on the media side is to increase clicks and ad revenues and increase your fears to do all of that. And their partners in crime on the big Wall Street side are looking for the same effect, to get you to react so that they can get you to move around and get more products in the portfolio. So what are we supposed to do? And why do we even tune in all the time to the big media? So one of the things Daniel Kahneman, who I call him the father of behavioral finance, he won the Nobel Prize in economics for his work on judgment and decision making. And he described hindsight as the ability to explain the past. And that ability to explain the past by listening to expert forecasters on CNBC, we think we have the ability to explain the past, which we do after it happened. And that gives us the illusion that the world in the future will be more understandable. And that's the problem. The world is not more understandable because someone explains to you why what just happened. But that's what the media has us trained to do in terms of our thought process about what they're reporting to us. There's a guy named Phil Tetlock, who's the co-author of a book called Super Forecasting. So this story and the plot thickens, meaning we tune in to the news to try and learn the past because that makes us think that we'll understand the future better. Here's what the problem is. What Tetlock found in his seminal work on expert forecasts is, in general, expert forecasters have about a 49% accuracy rate in general. So he looked at all the forecasts, and that's what he came up with. So basically, it's the same as a coin toss. But it gets worse. What he also found is that the smarter and the more famous, the smarter sounding and the more famous the forecaster, so the managing director from Goldman Sachs, who used to be a famous author, the smarter sounding and the more famous they are, the least accurate their forecasts. Guess who CNBC wants to have as guests on their media show? They want the most famous and the smartest sounding people, which are the least accurate forecasters. And that's who we are relying on to satisfy our hindsight bias. The ability to understand the past will help us to better understand the future of what lies ahead. As we learn all of this, we have to say to ourselves, when fame is the only predictor of accuracy, not level of education, right? Just fame. The more famous they are, the least accurate they're going to be. Now that I'm teaching you this, you'll know, don't listen to experts, quote unquote, expert forecasters, but understand that this is the game they play. And the smarter they are doesn't mean that the better forecaster they're going to be. It means that the better able they are to spin tales, to come up with a narrative to justify you believing in the desired outcome that they're actually talking about. The one thing I always say across the podcast is that there's one defining characteristic about the future, and that is that there are no facts about it. The person with the highest level PhD in finance or economics, the person who never went to college, the person who inherited money or built their own business successfully, none of those people have one more fact about the future than anyone who's listening to this podcast or than the podcaster, myself, has. So understand that just because they sound smart, it doesn't mean they know the future. In fact, recognize what we've just talked about. The smarter they sound, the more famous they are, the less their prediction is going to be accurate about the future. So there are three types of forecasters. This is important. There are those who don't know where the market is going. There are those who know they don't know where the market is going. And then there are those who know they don't know where the market is going, but they get paid a lot of money to pretend that they do. And that's the other thing to understand about the media and the big Wall Street firms. Who advertises on the media shows? Goldman Sachs, JP Morgan, the trading companies, Fidelity. So there's an incentive on both sides, right? They get invited on the shows, they pay the advertising fees. The more sensational the stories are, the higher the fees go, and the more afraid the investor is made to feel, the more likely the investor is going to buy more products and so forth. So it's a vicious cycle that at our expense, the investor's expense, is designed to help the big firms and the media to increase their profits. So here's, in conclusion, what we need to do to fend off against the effects of all this. One is go back to basics when it comes to your investment and your planning. You can listen to one of the more recent Fix It Fridays. It's called 10, 7, and 3, or the most important numbers in investing. So 10 is the long-term return for stocks, 6 is the equivalent long-term return for bonds, and 3 is the inflation rate. When you take the 10% for stocks and subtract inflation, you get 7% for the last 100 years of return in stocks. You do the same thing for bonds, the 6% for bonds minus the 3 inflation. You get 3% a year for the last 100 years. And so stocks have made about 2.5 times more than bonds. That's happened, by the way. I was born in the 60s. forever, but I'm just going to go from my lifetime. So 1960, the S&P was 60, and today it's about 6,000. So it's gone up 100 times. The millions turned into 100 million. Inflation maybe has gone up a little more than 10 times. So investing in real companies has continued, as it always has, to trounce inflation and do the job we needed to do. But it did that in the face of my lifetime of 3 halvings or more of the S&P 500 in 1973-4, in 2000 to 02, and then again in 2008 and 9. There have been about 9 or 10 recessions. There have been interest rates as high as almost 20 and as low as 0. Inflation as high as almost 20 and as low as close to 0. There have been Democrats and Republicans, right? So anyone who's tried to react to any of these news items or current event fears, who's president, when the pandemic is going to do, what the war in Russia and Ukraine is going to do, when they react by changing their portfolio, selling stocks and then buying back when, quote, the dust settles, studies show they've made less than half of the returns that for that period I just mentioned since 1960. It's close to the long-term average of about 10, 11% a year. So the best way that we can think about it is all I have to do when there are scary items and bad news reports as it relates to the financial markets to succeed and get that long-term 10% plus return is I need to do the hardest thing for human nature to do and the most important, which is nothing. And if times are tough, one of the best solutions I have for everyone is change from CNBC and tune in immediately to the Cartoon Network. I find that to be an effective strategy during tough times. Embrace the history of the markets that I just taught you, and recognize what Barry Ritholtz, who's another behavioral investment counselor who's very successful in our industry and very smart. He says the 3 most important words in investing are "I don't know." You'll never hear that from one of these Goldman Sachs or UBS or Morgan Stanley, you name it. 2 people on the screen ask the unanswerable question: is this the next bear market, or is this the beginning of an opportunity to buy? They'll never tell you, "I don't know," because that doesn't sell their story and lead to the goal of increasing fear, which increases their profits. So understand, if you ever ask an advisor that question, is this the next bear market? What's going to happen next year in the markets? If they tell you anything other than "I don't know," get up and run the other way. So hopefully this episode of Fix It Friday has been helpful and will help you to avoid the effect of what I call the illusion of predictive value, that somebody with a fancy title or fancy education somehow is predicting the future and that their predictions are actually likely to reflect whatever the actual outcome is going to be. It won't. You can listen to that podcast also when you get a chance, The Illusion of Predictive Value. I think it'll be helpful. I want to come back to one other thing. The media, the industry right now, the financial industry, is beginning to push what are called alternative investments. These are things like private equity, meaning investments in companies that don't trade on the public markets like an IBM or a Microsoft, and they lock your money up for a number of years, which is one of the reasons they push them. You can't really get out of them easily. They're not tradable. But they tell you that the reason they're pushing them is because they protect you from traditional stock market volatility. And one of the things I'm just going to point out is I got an email a couple of months ago during the April decline, or a month or so ago during the April decline, from a firm trying to get me to adopt alternative investments, private equity for a client. And what they pointed out is private equity has been very helpful during this 10% decline in 2 days, because they say the private investments don't show the decrease in value until sometime later. They don't what's called mark to market. So if I see IBM during those 2 days, it's gone down, let's say 10%. The private investments haven't even been calculated yet. So person looking at that private investment on the statement, tomorrow it looks the same as it did 2 days ago. So think of what they're telling you. They're not telling you to buy the private equity because it's a good investment. They're telling you buy it because it conceals the decline in the market. And so I leave you with that thought. It's very dangerous out there. So always go back to basics. You need more 10s stock returns than 6s bonds returns. And there's no facts about the future. Don't try to discern it, and stay on course and ignore the "if it bleeds, it leads" news. Thanks again for tuning in to Fix It Friday. Look forward to having all the listeners join us on the next episode. For those who might be joining for the first time, You can access the podcast on all your favorite venues, but you can also access it easily at crazywealthypodcast.com or on our website, fusionfamilywealth.com. Everybody, hopefully will have a good summer. Until next time.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.